Price-earnings ratio is one of the most commonly used metric to value equities. Why is it so common? Well, one reason is of course the simplicity with which it can be calculated. It is arrived at by simply dividing the current market price of the share by its EPS, or its earnings per share. This EPS could be the EPS as per the profit and loss account of the last year, or to be more accurate and precise, it is taken as the sum of the EPS of the last 4 quarters, or the EPS TTM. What does the price earnings ratio indicate? Simply put, it indicates how much are the investors willing to pay today to get the future earnings of the company. Now, one question that gets repeated all the time is, what is a good PE ratio at which I must look at buying a stock? The answer to that question is of course that you cannot have a universally acceptable PE ratio for all the companies across all the sectors. The PE ratio varies for various stocks based on many factors such as the company's financial track record, its management quality, competitive advantages, and its future outlook. Most importantly, however, the PE ratio varies depending upon the growth potential in the company's earnings. Let's try to understand this with an example. Let's assume that company A's shares trade at ₹90 per share and that the company has an EPS of ₹10. This gives the company a price earnings ratio of ₹9. Now, if we assume that company A's EPS will remain constant in future, it will then take 9 years for the investors to earn back their investment of ₹90 per share. Now, in reality, the market expects the earnings of company A to grow at a rate higher in future. And just for the sake of this example, let's assume that investors expect a 35% year-on-year growth in the company's EPS. Now, if you look at the table on the right, you will see that in such a case, the investor will earn back his ₹90 within 4 years, which is at the end of financial year 2016 when the accumulated EPS grows to about 89.54. Now, as I said, that whether a company's PE ratio is good or bad depends on many factors. You will see that some companies command a much higher PE ratio in comparison to others. In particular, some sectors command a high PE ratio in general in comparison to companies in other sectors. For example, technology and FMCG companies always command a higher PE ratio since it is believed that their earnings grow at a faster pace. And since your money will grow at a faster pace, you will pay more today to get a part of this growth in future. Now, you may often hear analysts talking about the forward PE multiple. What do they mean? A forward PE multiple is arrived at by dividing the current market price of the share by its expected EPS at a future date. In our example, assuming a 35% EPS growth, company A's EPS will be at 24.60 in the year 2015. Thus, at the current price of ₹90, the stock is said to have a forward PE multiple of 3.66 times its 2015 earnings.